This is Global Finance, Topic 9A, Currency Forwards by Lou Gaddis. In this topic, we're going to look at the futures of a forward contract, describe what it is, what are the terms. We'll talk about the payoffs and profits of a forward contract on currencies. We'll talk about how to both speculate and then hedge using forward contracts. Specifically, how financial managers in a corporate finance setting use forward contracts to hedge. So let's start with an example. Suppose you have inside information that the European Central Bank is going to make a surprise announcement and raise interest rates next week. We learn that a rising real interest rate will attract investment. Investors will then need to buy the currency to buy their bonds. So we expect the euro to appreciate over this period. Specifically, we expect that the euro is going to go from the current market, say 147.86 bid to 147.87 ask, to a market of around $1.55 per euro in 1 week. And you only have $5,000 to spend on this speculation. So, with $5,000 and a cost of a euro of 147.87, we can buy 3,381 euros for $5,000. And if the euro does appreciate to 155, your profit is going to be 241. That is, your cost of euros will be $1.4787, and then you could sell them into the spot market next week at 155 times my number of euros, 3,381, for a profit of 241. In this case, it's just like speculating on any penny stock they expect to rise. However, if the euro does, say, fall to $1.40 and you paid $1.47, you're going to lose over 7 cents a euro and lose 266. So this example, we call this trading spots or trading currencies in the spot market. However, you could speculate using forward contracts, and one of the main advantages is it may not require any upfront payment, and you can take much larger positions. So let's talk about what a forward contract is. All right, a forward contract is simply a contract negotiated between two parties. We call these parties the counterparties of the contract. And in this contract, you just agree to buy or sell a currency, or I should say buy and sell a currency at a future date and time. And what you need to specify is the pair. All right, the currency pair would mean I want to buy euros, and then I would need to sell dollars. So I'll exchange you dollars for euros, or dollars for yen, or dollars for whatever. However, it doesn't have to be based on the dollar. You need to specify that I want to buy, say, 100,000 euros next week, all right, the delivery date, and they're going to be delivered to my, say, New York office. And you need to specify the price. I'd like to pay, say, $1.20 or $1.30 per euro. All right, now these forward contracts can be physical delivery or cash settlement. Physical delivery means you'll actually get a delivery of the euros. Cash settlement means that we won't actually deliver the euros, but if you're, say, a buyer at $1.20 in the forward contract, and at the time the contract expires, the euro is selling for $1.30, the other side of the contract will just give you 10 cents per euro profit. In this contract, we also need to specify who is the buyer and who is the seller of the foreign currency. So from an American's perspective, the long party is also called the buyer of the forward contract, and that is the counterparty in the contract that takes delivery of the foreign currency. In other words, if I'm long or I bought the forward, now you didn't really buy the forward, you just entered into an agreement to buy the euros. If I am long or the buyer of that contract, I will buy the euros and give you dollars. The short party to that contract, or also called the seller of the forward, is the person that delivers the euros. So that person, the short party, has a contract to deliver euros and take possession of dollars, in other words, buy dollars. Now, euro or forward contracts generally don't have a margin, or we call it a security deposit if you're talking about, say, rents. But a contract may specify that both parties have to post a margin, or again, like a security deposit, to ensure that the contract is followed up on. So an example would be you have a forward contract to buy 100,000 euros at $1.25, and you agree upon an initial margin of 10%, that means that both counterparties, both the long and the short counterparty, will deliver 10% of that contract value, $100.25 times 100,000 euros, or $12,500 into an account and gain interest. Now, once you own a forward contract, or in other words, you're a long party to a forward contract, you then benefit if the price of the commodity goes above the forward price. So, for example, if you go long at $1.25, you have a contract in which you agree to buy 100,000 euros at $1.25. You will make money as long as the spot price at maturity is greater than $1.25. If it's say $1.26, you will be forced to buy at $1.25, and then you can sell them into the spot market at $1.26. So we say that the forward profit and payoff of a forward contract is ST minus F0T times quantity. So ST will be the spot price of the commodity, say in this case euros, at the maturity of the forward contract. F0T is the price I agreed upon at time 0 for delivery at time t. So for example, today we agree to exchange 100,000 euros next week for $1.25. F0T is the forward price today that I agreed upon $1.25 for maturity at time t next week. Now, if next week rolls around and the spot price is above, I'll make money. The short party has a different payoff. It's F minus ST times quantity. The short party is selling the euros at F0T, and their profit is F minus ST because they'd have to go out and purchase the asset in the spot market to deliver it to the counterparty. Here's what some of these prices look like on a Bloomberg screen. So we can see here at the spot price of the euro is 147.86, 147.87 at that time. And we can see the 1 week forwards. Now the forward prices are often communicated with pips. So in this case, the 1 week forward to purchase euros is negative 5.35 pips. So what that means is pips are price points, and this is a 4 decimal place currency, so 5 pips refers to that 4th decimal place right here. So we need to subtract 0.0000535 from that decimal place. But bottom line, the price is listed right here. The price to buy euros a week from now is $1.478165 from Bloomberg. The price to buy them today is $1.47, and what you see is the price is going down over time. So we can say the euro in this case is at a forward discount, is getting cheaper to buy for later maturities. So back to our example, we have inside information the euro is going to appreciate to about $1.25 in the current spot price. So what is our profit if we use our $5,000 to buy euros? All right, from the last screen, remember that the price of the euros is $1.4787 in spot markets, and the 1 week forward is $1.478165. Say you have $5,000 to spend, but this forward contract requires a 5% margin. So the question is, well, how many euros can I get a contract on? Well, the initial margin, that security deposit, is equal to the initial margin percent times the number of euros times the forward price of the euro. If I have $5,000 to spend, and the initial margin is 5%, and the forward price is $1.478165, I could solve this equation for Q and see that I could enter into a contract to buy 67,651 euros. So a week rolls around, and we actually do see that the euro does appreciate to $1.55. So what is our profit? So the profit formula from the last slide for a long forward is going to be ST minus F times Q. And that's F0T, since we agreed upon it last week. And that's going to be $1.55 per euro minus $1.478165 per euro times 67,651 euros. The euros cancel out, gives you an answer in profit, and that answer is C, 4,860. Now you can verify on your own that if the price goes to $1.40, your profit is negative 5,288. All right, what you noticed here is the profits are much greater than they were when using simple spot transactions with no leverage. And specifically, it's about 20 times greater in this example because we only had to put 5% of the value of the position up. So we only had to deposit 1/20th of the value, and so we basically get 20 times the profits. Now, most of the examples we're going to use are examples in which we are going to use forward contracts to hedge and not take risk. All right, hedging refers to reducing risk by taking on an offsetting position. So an example would be, say, for an asset, say you expect to receive euros in 3 months. Okay, say we expect to receive let's make that euros, 1 million euros in 3 months. Now, if the euro appreciates, we're going to get more dollars when we sell the euros. If the euro depreciates, we're going to get less dollars when we sell the euros. So this receivable, we say, is long the euro. We have a long position in the euro. All right, how we're going to hedge that position is by taking a short position in a euro forward contract. So then I'm going to hedge by shorting the euro forward, which makes sense. If I expect to receive through my accounts receivable euros, I can hedge by having a contract to sell that 1 million euros at a fixed price, and therefore we've reduced our risk. We actually eliminated our risk. Here's another example on a liability. So say we have a kroner accounts payable. Say we have to pay 500,000 kroner next period. Well, now our risk is that the kroner appreciates. If the kroner appreciates, it'll cost us more money to acquire the kroner to then deliver to, say, our vendor. So we actually have a short position in the crown, given that if it appreciates, we lose. So how we hedge that position is by taking a long forward position, which again makes sense. If I have an obligation to deliver krone next period, I hedge that by getting a contract to buy crown next period at a fixed price, and that's what a long forward is. Here's another example of using forward contracts to hedge. Suppose you enter into a venture which is going to cost you 200,000 euros today, and you're going to receive 75,000 euros in 1 month, 2 months, and 3 months. The question is, well, once I pay the 200,000 euros today, what is my exposure now? Am I exposed to an appreciating or depreciating euro? Right? The answer is, well, you're exposed to a depreciating euro. Once I buy the euros today, now I have a receivables or expected receivables of euros in the future. If the euro then depreciates, I'm going to be worse off. I'm going to get less dollars. So let's do this example first here. Say we hedge our position. We want to get out of our risk. What we could do is once we purchase our 200,000 euros at $1.4787, that's the spot price, and that's the ask spot price, so that's the price to buy euros. We can then enter into 3 contracts to sell euros in 1 month, 2 months, and 3 months. And the Bloomberg gives us indications of where those prices are. So according to Bloomberg, it looks like if I'm a seller of euros, I could get, say, $1.47,648 and 9.44 and 25.92, quoting the last few pips. So I can try calling up a bank and asking them to give me enter into a contract in which I am going to sell 75,000 euros in 1, 2, and 3 months. And you could ask for these prices that you saw on Bloomberg. And at that point, then it becomes a negotiation. And actually, the prices from Bloomberg are from other financial institutions have put up quoted prices to buy and sell. So I could do that, and once I enter into those forward contracts for the last 3 months and made my spot purchase, now I'm locked into a profit of 34,923. Here's just an example that, well, you could have done better if you didn't hedge. Maybe, say the spot price doesn't depreciate like the forward says, and it stays at 147.86 bid, 147.87 ask for all 3 months. In that case, we're going to get 147.86 for those euros for the next 3 months. I'll actually make more profit. So it looks like I would have been better off, but that's not the point of hedging. The point of hedging is once I get into this position and I have my euros fully covered or hedged, I no longer worry about them. I don't have to worry that if Greece defaults on their bonds and the euro depreciates, I'm going to get less money. Or if Germany does not reaffirm their support for the European Union, maybe the euro devalue. So the point of hedging is to eliminate risk so we don't worry about it. But you can always do better. Also, when we talk about hedging, it's not always all or no hedging. Many companies have a hedge ratio. In other words, they say, well, over the next several months, I want to hedge, say, 50, 75, or even 90 or 100% of my exposure to the major currencies. So why they might do this, one is simple estimation errors. I don't know exactly what my receivables are, so if I estimate they're going to be 100,000 euros next period or 75,000 euros period, it may not materialize. So for that reason alone, we might choose to hedge only 70 or 80% of them. So if we have a receivable of 100,000 euros, that's only an estimate. So maybe we'll have a contract to sell 75,000 of them. In other words, a hedge ratio of 75%. Here's an example where IBM estimates it's going to receive 100 million euro in 1 year. That's a long time out. So what they decide is they want to have a hedge or a coverage ratio of 50%. So they take a short forward and 50 million of the euros at $1.30 per euro. And then the other 50 million euro, they'll just get the prevailing spot price. So they've fixed the price of half their euros. So at the time of maturity, say again a year from now, they know that 50 million will get the forward price. And if the spot price, say, is 120 next year, so they were worried about the euro devaluing, and it did, that is the one in which they have the risk on. But you see that their risk is only on half their position, so they've been able to eliminate half their risk. Why we're talking about hedging, let's just give a few arguments why you may or may not hedge for a corporation. Obviously, companies might say that they're more predictable cash flows. If I can hedge all my cash flows, say my euro receivables, then I know how many dollars I'm going to get, and therefore I can make better plans and put projects in place that require funding. Some say you can reduce earnings volatility, which may increase the value of the stock if your cash flows are not fluctuating with exchange rates. You're going to have maybe a lower standard deviation of earnings, and maybe that gives you a lower beta, which that gives you a higher valuation. If you face a progressive tax rate system, spikes in profits due to exchange rates might trigger higher tax rates, and therefore you might be better off having a smoother tax or a smoother earnings flow and lower taxes. And then lastly, if you were to hedge all the things that a manager can't control, like the value of the euro, and you want to measure a manager's ability to manage, say, a German investment, maybe it's best to hedge all those risks they cannot control, hedge 100% of, say, their exposure in the euro, and therefore the profit changes will be driven by the manager's ability to, say, cut costs or increase sales. The disadvantages of trading, one, once you enter into trading, you will pay bid-ask spreads in forward markets. You may pay, fees related to entering into, say, options or futures contracts. So it is costly. Another argument against it is, well, stockholders can be hedged against foreign exchange risk. I can own both European and American stocks, so when the exchange rate changes, it benefits some and hurts others. And if there are trading costs, why don't you just let shareholders hedge by holding a global diversified portfolio of stocks? Another argument against hedging is management is not diversified. Say the CEO and CFO and senior officers of a corporation are getting a significant part of their wealth from that corporation and maybe even their pension. So they may have incentives if you have a hedging scheme to maybe overhedge and not take enough risk at the expense of the stockholder. And lastly, the reputation of a derivative like a forward contract to be a financial instrument of mass destruction, you can get in a lot of trouble with derivatives. You could say enter into a position that due to an error, maybe I do €1 billion instead of €1 million by changing decimal places, or maybe I go long where I should have gone short, or maybe you have a rogue trader that starts trading on behalf of the firm's name and takes a huge loss. However, with all the advantages and disadvantages, most Fortune 500 companies hedge risk, and specifically hedge it by using derivative contracts, and two of the biggest ones are interest rates and currencies. All right, so to summarize, let's talk about a spot transaction, say in currencies, would be to say call a broker and say you'd like to purchase euros today, or you go to your local bank and you can actually purchase euros today right before your trip, where you pay for the euros today and take near immediate delivery, maybe seconds later. If I buy euros in financial markets using, say, a financial system, it may take 1 or 2 days or 3 days to deliver. So that was called a spot or a cash transaction. All right. A forward transaction is one in which you agree upon the price and the currency and the delivery date and the delivery location. Everything's agreed upon right up front, and those terms are agreed upon, a contract is signed, and you just wait around for delivery. And then you say deliver dollars and they deliver you euros. A futures contract is a form of a forward contract, and actually all futures contracts are forward contracts, and those are just forward contracts that are traded on an organized exchange where a lot of the terms are standardized to help the liquidity of the positions. However, most currencies are traded using forwards and not futures. And then lastly, when we talk about futures contracts versus forwards, forward contracts are traded on what we call the OTC market, the over-the-counter market. This simply means it's not traded on an organized exchange. There's no central location in New York. There's nowhere to take a picture where all these are traded. It's just a network of banks and dealers and brokers and other financial institutions. However, futures are traded on an exchange like the NYMEX, the New York Mercantile Exchange, or the Chicago Mercantile Exchange. Forward contracts are negotiated. Everything's negotiated. The price, the quantity, the delivery date, the delivery location. In a futures contract, it's take it or leave it. We have contract sizes of 125,000 euros, and the current futures price is $1.22, and delivery months are third Fridays of every month. Take it or leave it. There's some quoting differences. Sometimes forwards are quoted in terms of indirect quotes, FX per dollar, and forwards are in dollar per FX. Forwards, the transaction fees or costs are the bid-ask spread, so there's a higher price to buy than sell. In the futures contract, it's a fee. Forward contracts are considered to have relatively high counterparty risk. In other words, you have a contract with one other institution, and that institution may fail to deliver the euros when you agree upon it. On the other hand, exchanges are considered to have low or no risk of credit risk, meaning that no organized exchange has failed in the United States, even through the Great Depression and the Great Recession. There's usually not a margin or security deposit on a forward contract, but there usually is, well, always is going to be a margin on futures contract. And on closing out position, all forwards and futures are obligation to deliver, and most of forward contracts are physical delivery. They're not cash settle. However, futures contract, which we'll talk about in a later topic, you can get out of the positions. You cannot escape gains and losses, but you could say take a loss and then get out of the position by taking an offsetting trade. In other words, forward contracts are settled at maturity. That's where all the payment and delivery happens. On a futures contract, you could decide to, say, liquidate a position after a certain period of time. So there's a daily mark-to-market or profit calculation. So that is the basics of currency forward markets.